What's driving markets? Welcome to Market Take. Each week, we'll bring you our insights on the latest market and economic trends that are impacting investments. I'm your host, Nicholas Fawcett, Senior Economist at the BlackRock Investment Institute. This week, we look at how renewed worries over the Federal Reserve's independence are putting immutable economic laws back in focus. Mega forces were a major driver of financial markets and macro in 2025, and that's playing out again this year. And we're watching one key indicator: long-term Treasury yields. They haven't declined like they did historically when the Fed cut interest rates. That's partly because investors are demanding more compensation for the risk of holding long-term US bonds, or term premium. Why? One reason is high and rising debt burdens, which mean more bond issuance. And that's structural, not a short-term cyclical development. Though we saw something similar in 2025, ensuing data showed a softening labour market, which gave the Fed cover to cut rates. Now, market attention is back on concerns about central bank independence. December jobs data indicated that the US is still in the no hiring, no firing stasis we've previously described, and doesn't look at risk of a sudden deterioration. And wage gains and core services inflation suggest there's a risk that inflation persists above the Fed's 2% target. That could lead to fresh policy tensions between inflation and debt sustainability, and spark investors demanding even more term premium. But we think immutable economic laws are still at play, because any rapid rise in long-term yields would quickly impact debt sustainability. We've long expected investors to demand more term premium, driven by looser fiscal policy, greater bond market volatility, and heightened inflation uncertainty. In fact, we see US term premium doubling over a 5-year horizon, but that move could be quicker or larger than we expect. And higher term premium isn't automatically negative for equities, in our view. What matters is the relative preference that investors have and how they're assessing risk. With mega forces driving markets and economies, many potential outcomes are possible over the long term. This reinforces our calls for being nimble and having a solid plan B for portfolios. Here's our market take. Renewed market worries over Fed independence underscore our underweight to long-term treasuries on a tactical and strategic horizon. We think investors need to stay nimble and ready with a plan B, as outlined in our 2026 Global Outlook. For details, read our weekly market commentary. Go to www.blackrock.com/weekly-commentary. Thank you for tuning in. If you've enjoyed this episode, subscribe to Market Take wherever you get your podcasts.
This content is for informational purposes only and is not an offer or a solicitation. Reliance upon information in this material is at the sole discretion of the listener. In the UK and non-European Economic Area countries, this is authorised and regulated by the Financial Conduct Authority. In the European Economic Area, this is authorised and regulated by the Netherlands Authority for the Financial Markets. Reference to the names of each company mentioned in this communication is merely for explaining the investment strategy and should not be construed as investment advice or investment recommendation of those companies. For full disclosures, go to blackrock.com/corporate/compliance/bid-disclosures.